When we talk about acquisitions here, it's really about an acquirer like Society Brands acquiring a company. The benefit to a brand owner is you could multiply your years of earnings. You could also take risk off the table. All of us entrepreneurs are very bullish as to what the future holds. But as we know, sometimes things don't always continue to keep on going up and to the right. A lot of business owners have almost all their wealth tied up into their business. Instead of constantly doubling down in your business, you could essentially de risk your own personal wealth, get liquidity, but also enjoy the upside in the way of performance based earnouts, roll to equity. And you also get additional resources to help you scale your business.
Do you want to grow your business bigger and faster? A free audit of your Amazon business can help you see and avoid threats and find missed golden opportunities to grow your business. I generally charge anywhere from $150 to $300 an hour, but this would be free. You can be a reseller or you can be a brand owner. All I ask is that you're doing a few $1,000s a month in sales already. To book, just visit myamazonaudit.com. That's myamazonaudit.com to book in our call. Ladies and gentlemen, boys and girls, welcome back to the 10K Collective podcast for 6, 7, 8-figure Amazon sellers. Now, Amazon sellers, what does that mean? E-commerce business owners, I guess, because today we are talking about the exciting world of acquiring businesses as a way of growing your business. We're talking to Michael Sirpilla of Society Brands, formerly NCAP 33, and they are a tech-enabled consumer products company that acquires consumer brands in the health and personal space. So both very specific and kind of requires a bit of unpacking, really, doesn't it? First of all, Michael, welcome to the show. Thank you so much for coming on.
Thanks for having me, Michael. Happy to be back.
Yeah, it's interesting to talk to you. So last time we spoke was 2 or 3 years ago. We're in mid 2024 now, and the aggregators were busy buying every e-commerce business in sight. Now the world has changed, hasn't it, really? So first of all, let's just go through a couple of things. We ought to unpack, first of all, what Society Brands does and what you do in a few sentences.
Yeah. So Society Brands, as you mentioned, is a tech-enabled consumer products company. We acquire and operate direct consumer, generally e-commerce native brands. And we help them scale post-acquisition. So we've done 12 deals to date. And so far, our brands on a consolidated basis are growing significantly year over year. We're profitable as an organization, and we plug them into our operating infrastructure, help them grow. But we also have those founders stay on board. For the most part, that's not always the case, but generally speaking, we have the founders stay on for at least a year or two. And post acquisition, we offer them additional resources. We offer them cash at close, rolled equity, and they help us scale Society Brands to what I strongly believe will eventually be a very successful, likely publicly traded company when the markets get to be in a much more stable place than what they currently are today. So, at a super high level, that's what we do, and that's what we're able to offer to brand owners.
Fantastic. Yeah. So there's a few things to unpack there, I think. But before we get into that, what do you mean by acquisition in this context? And why would you bother doing this rather than growing organically? So 2 questions in one.
Yeah. So when we kind of think of acquisitions, right? If you're a brand owner, you might think of acquisitions as acquiring customers, right? Of course, that is a way that you can grow through quote unquote acquisition, I guess, right? By acquiring customers through paid advertising or whatever the case may be. When we talk about acquisitions here, it's really about an acquirer like Society Brands acquiring a company, right? So what we do is we essentially pay a multiple based off of what 1 year's profit is. So you look at on a trailing 12 months, the last 12 months, you look at your profitability, and a buyer is normally willing to pay some sort of multiplier on what your last year's EBITDA or profit was for that year. And they acquire essentially 100% of the business. It doesn't necessarily have to be 100%. It could be a partial exit as well, just depending on what the acquirer is looking for. And the benefit to a brand founder or a brand owner is you could multiply your years of earnings. You could also take risk off the table, right? As you're growing your brand, all of us entrepreneurs are very bullish as to what the future holds. But as we know, sometimes things don't always continue to keep on going up and to the right. So this helps you as a brand founder take liquidity, and instead of constantly doubling down in your business, you could essentially de-risk your own personal wealth. A lot of business owners have almost all their wealth tied up into their business. This allows you to de-risk, get liquidity, but also enjoy the upside in the way of performance-based earnouts, roll to equity. There's a number of different ways that a buyer could essentially help you. And you also get additional resources, which if you're a small brand owner, you're limited to the resources that you have at your fingertips. A buyer, whether it's Society Brands or somebody else, generally has more resources available to help you scale your business.
Interesting. So, well, now we've got some of the basics out of the way. Let's deal with some of the more sophisticated things you're looking at. So, I mentioned before, I think the first question has to be about the trends. So, famously, some of the big aggregators, especially the ones who even sort of founded the concept of an aggregator, have gone out of business. Everyone else seems to have stopped buying or very minimal buying activity. At least that's a perception I have. So, how's the e-commerce acquisition landscape really evolved in the last year or two for you?
Yeah. So a couple of things on that. I mean, one, we have acquired significantly over the past year. We've done many deals. We've gone from 6 brands to 12, but we have been a little bit more selective. There are acquirers out there that went out and did 100 acquisitions or 200 acquisitions, a whole bunch of really smaller brands. That's just never been our approach. There might be some that are successful with that approach, but with us, what we focused on is larger scale acquisitions. So brands that do anywhere from 5 to 20 or $30 million of revenue, because we find that it's easier to manage larger businesses than what it is small brands that acquiring 30, 40, 50 of them. So that's one thing that's a little bit different with us in comparison to maybe an Amazon aggregator that acquires 100 or hundreds of brands. Another thing that we've kind of seen in the marketplace is getting more focus from a category perspective is key. It's hard to be experts in everything. There are some acquirers out there that really focus on home goods, and they really are specialized in that approach. There are others like Society that focuses on health and personal care, still generally broad, but more geared towards health and wellness, where we essentially help consumers feel good, look good, and live a better life. That's really what our slogan here is at Society is. And we stay focused on that. That's what my background was, is in the health and wellness space prior to starting Society. I partnered in a population health management company, scaled that to a large business before founding Society Brands. So that's kind of like what our focus is. And that's kind of maybe the second point is instead of doing a whole bunch of acquisitions, more focused on larger acquisitions. And then two, category focus. And then the third thing is, I would say, profitability. It's so important for an acquirer to get to that level of profitability. At Society, we are profitable today on a consolidated basis. And I think that that's another thing that instead of growing at all costs, which is the old aggregator slogan, really focused on profitability, the core fundamentals of a business, whether you're a small brand that does $10,000 a month on Amazon, or if you're a large scale business that does 10 million a month on D2C and Amazon and a whole bunch of other e-commerce marketplaces, there's one thing that just reigns true, and that is profitability. Then the last thing that we've seen that's really critical as it pertains to the aggregator space is how are the brands doing post acquisition? Are they growing or are they declining? Are the brands better with you or are they better without you? And so I think that there's an increased sense of organic growth on if you're a consolidator and you're acquiring e-commerce brands. And at Society, what we focus on is really four things. I coined this phrase. It's an acronym called RACO, RACO. The R stands for raising capital. How's Society doing from a capital raise perspective, whether it's debt or equity or combination of the two? The second thing is acquisitions, acquire great brands at prices that we can afford that are fair to the founders as well. So that's the A. The C is controlling our costs. That's another thing that other aggregators have maybe struggled with is controlling their corporate overhead and making sure they're not getting too bloated from an OpEx perspective. So C is controlling our costs, and O is that point that I mentioned a few minutes ago, which is organic growth, making sure that the brands post acquisition are growing. I think those four things are the core pillars of why Society Brands has been successful to date, but also what others should be focused on as well. And I think that if there has been failures in this space, likely they're lacking a one or two or maybe all of those categories.
Amazing. There's just so much to unpack here. So let me just unpack a little bit of what I think is important. And let's just jam on this for a bit. So the first thing is I noticed with a lot of small business owners, so they're not acquiring at all. So what they call growth, or what you're calling organic growth doesn't just mean you're not spending money on ads, by the way, which is one of the phrases that use digitally focused marketers tend to think in terms, but we're talking about growing a business without buying another one, right? So a lot of them think of business growth equals revenue growth. And I keep beating my masterminds up about that. I'm like, just forget about revenue, guys. It's all about profit. Because as you said, the value of a business is a multiple of the profits in this space and in most small business acquisitions, small, medium business, right? So I think that's so healthy and it makes sense to me. And it kind of doesn't surprise me that the aggregators went a bit funny growing revenue without growing profits because lest we forget, profit is sanity, but cash is reality, right? If you haven't got cash flow from that, sooner or later, when the Goldman Sachs bankers stop funding you or the rate of interest goes up in your debt, you're in big trouble, right? So, how do you think people can shift out of that mentality, or is it just a reality that you think has dawned on people finally? What are your thoughts?
So I think that it all depends on the market that we're in. It's always funny when you're in a really frothy market where everybody, it's a sunny day every single day, and the public markets are doing very well. The economy is doing great, whether it's in the US or the UK or wherever somebody is around the globe. Capital providers, and there's capital that's very easy to get access to. Generally, companies focus on growth, and it's a growth at all cost mindset. And when things get to be a little bit tighter, like it is here in the US, where interest rates are higher, right? So interest rates are higher. People are a little bit more skeptical as to what the economy is going to do, how the consumer is going to respond to the economy. And capital markets get a little bit tighter. And then what do companies do? They focus on profitability. Well, what we've focused on since the very beginning is profitability. We just have always focused on that. This is my first business that I've actually ever raised capital for. I've been an entrepreneur for the past 15 years, but I've really bootstrapped every business that I've started. And I was using my own capital to grow and operate various different ventures that I've started. And because of that, I think that that's been beneficial for society is the thought of having a burn, the thought of just growing at all costs. It's just not been the way that I've operated historically. And I think that that is the fundamental truth that reigns king in any market is how are you doing from a profitability perspective and are you growing? And Michael, to your point, thank you for clarifying. Organic growth when you're a company that grows through M&A, that means that that doesn't necessarily mean that it's organic traffic, right? We look at organic growth as like non M&A growth, right? So like, are we growing our brands that we've acquired, whether it's through paid media or organic search? So that's a really clear distinction. But is a company going to trade for a revenue multiple or a profit multiple? In any market, one thing that you could just rest on if you're a small FBA seller or if you're a larger organization like Society is if you are profitable and if you are growing, then there will be market value for your business. But if you are not profitable and if you're relying on some sort of revenue multiple or something like that, you might be able to get that, but you could only do that in a really frothy, excitable capital environment. And that's not what we're in today.
Excellent. Well, thank you for those reality checks. You've got that in your DNA as an entrepreneur to grow without needing to raise capital. And that stood you in good stead. So let's think about the acquisition targets. This will be interesting both to those who want to grow through acquisition, but also those who own a business which might be acquired by somebody like you. What do you consider when you're evaluating potential acquisition targets? And before we do that, we better define what do you mean by this phrase tech enabled consumer product company?
Yeah. So tech enabled, we're not looking to acquire tech enabled consumer products companies. We
Yeah.
We are a tech-enabled consumer products company. So
Yeah.
what does that mean? It
Yeah.
doesn't mean that we're a tech company. We're not a technology company. We have built out some proprietary technology, but we work with various different third-party service providers because we're of the belief that if there's great service providers out there that provide us data analytics, AI, you name it, right? We can plug into that and be a client of theirs versus having to spend millions of dollars to essentially build out our own tech. So really the big aspect of what we've built as society from a technology perspective is the integration between how do all these service providers communicate with each other. And we're able to look at data on a year over year basis at society every single day on how all of our brands are doing from a revenue perspective, from a contribution margin perspective, from their advertising metrics on ROAS, tacos, you name it, right? On demand planning from an inventory management perspective, when we have to buy more products, when we're oversupplied in certain products, right? So that's what we mean by tech enabled. And consumer products company means just, we acquire consumer product brands, generally in the health and personal care space. The first part of your question, Michael, as to how it pertains to how we look at M&A, mergers and acquisitions, how we look at acquisition targets. Ours is different for I'll answer how we do it, and it might be slightly different for each company. So society focuses on brands that are doing anywhere from $5 million of revenue, could be as high as $30 million of revenue. We want to see strong profit margins on the low end, 15% profit margins, on the high end, 25%. Getting higher than 25%, there's a phrase that pigs get fat, hogs get slaughtered. And if you have 50% profit margins, boy, that's great for you, but a buyer doesn't necessarily want to be on the receiving end of the inevitable margin compression that's going to happen. So so if we're paying a multiple on a 50% EBITDA margin as an example, that is a great thing for the seller, not so good for the buyer. So likely they're going to try to normalize your EBITDA margin. And if you're a seller, you're going to want to be open to that because you want it to be successful for the buyer, just like you want it to be successful for you as a seller. So 15 to 25% profit margins, strong year over year growth. We want to see at least 10 to 15% year over year growth. Um, and we also want to make sure that there's not so much, there's not all these SKUs out there to where you're generating all this revenue on hundreds or potentially thousands of SKUs. We want to make sure that it's really profitable. Then there's category specific things on what we focus on. We look at lifetime value. We look at customer acquisition costs. We look at what various different trends are from a margin perspective as well. We could dive so deep into all that, but hopefully that gives your listeners at least a sense as to what us and potentially other acquirers look at.
That's one question that comes up. So let me dig into that a tiny bit. How many SKUs is too many SKUs? Do you have a metric, sort of profit per SKU or revenue per SKU or something? Because I have some clients who have like 10,000 SKUs, and some who have like 10. And I suppose they do between a million and 10 million in revenue a year. Do you have a way of dealing with that?
Yeah, so 10,000 SKUs is okay if they have enough revenue to support it, right? And 10 SKUs is okay if they have the revenue to support it. So the revenue per SKU that we like to see is anywhere from 50,000 to 100,000 per SKU, but we could be flexible on that. I mean, there's certainly examples to where we don't want to see $1,000 per SKU or $5,000 per SKU. We could be somewhat flexible on that. We just need to have a good understanding of what the business model is. And it's not like the biggest pillar for us. So we could be generally flexible, but it typically ranges between 50 to 100,000 per SKU.
Interesting. And I think that's a very good corrective to that whole I've got 1,000 products and I mustn't kill any of them off ever. I presume that's per year, not per month. Is that right?
Yeah, that's right.
Okay. But still, I mean, there's a lot of people that are selling SKUs that do, a couple of $1,000s a year, and they consider, particularly if you're in the smaller markets, UK or Europe, they will keep that going. But what they're not thinking about is the management overhead per SKU relative to the revenue, or let's face it, the profit that it generates, the actual value it's bringing, right? So I think that's an important mentality that I also encounter there. one has to be ruthless about the value of individual parts of your business at the SKU level as well. Now, the other one I want to talk about is the normalizing margins. You mentioned that. Now, obviously, if somebody has a 50% margin, I don't want to get distracted by a sort of acronym soup, but SDE versus EBITDA, it basically is the owner paying themselves for the labor they put in to run a business. How do you deal with that whole question of which margin you're looking at? And let's try and use the simplest language possible so we don't get down too many rabbit holes here.
Yeah. So SDE normally is just like the profit of the business, not including the founder taking money out, right? And there are buyers out there that will pay a multiple on SDE. But I think that the buyers who have paid multiples on SDE generally have really gotten hurt a lot over the past several years, because what ends up happening is if your profit is $1 million per year or $100,000 per year, whatever it is, and that's your seller discretionary earnings, right? Your profit, not including what you pay yourself. We're adding back your salary, however you look at that. The the problem with that is it's not like it doesn't take team members to run that brand. And what the aggregators of old used to say is, well, we have this big infrastructure and we could just take that over. But it's not without a cost. That's the thing, because it's not. Maybe they have a little level of scale that they have to where they could add on a few additional acquisitions, but eventually they're going to need to scale their corporate operations in order to take on more M&A and to do additional acquisitions. So if you're profiting $1 million a year and that's your SDE, and let's say that a buyer pays 3 times, so that's $3 million, right? But it takes the buyer $500,000 of team members to run that P&L, that profit and loss statement, right? Then technically that business is only profiting $500,000 per year, not a million. And they didn't pay 3x, they paid 6, right? That's essentially how that math works. And that's where a lot of buyers have gotten into challenges. So that's the reason why a buyer underwriting EBITDA on, hey, what's it actually take to run this thing, right? Like if it's profiting $1 million a year, does it take 300 grand to run the brand? Okay, well then it's not $1 million a year profit. It's 700,000, right? If it takes 500 grand, it's not $1 million profit. It's $500,000 profit, right?
Yeah.
And then the seller essentially get a multiple on that. And then essentially what happens is now that that buyer is essentially allocated the right amount of resources. They've kind of earmarked, here's essentially the dollars that it takes to run. And therefore it works for the buyer as well. So that's kind of like the delta between SDE and EBITDA.
Yeah.
There's another thing, Michael, that I can elaborate on as it talks about normalizations. That's maybe a
Yeah.
different question, but does that answer your question
It
there on?
does. It really, really does. So thank you for clarifying that. So now let's talk about normalizing
Yeah.
earnings further, because that's not all it is. So tell me about normalizing earnings from that point.
Yeah. So as it comes to normalizing earnings, kind of the pigs get fat, hogs get slaughtered. Comment that I mentioned previously on if somebody's running a 50% EBITDA margin or contribution margin or SDE, however we want to define that. Let's just say it's SDE for this example. That probably means that you found a really unique product and you don't have a lot of competition right now. That's a general statement that I'm making. That's not necessarily always the case, right? Well, if you have this blue ocean that you created for yourself and you found a really great niche and it's growing significantly, there will be other competitors that come in eventually. It's almost guaranteed that that's going to happen. If a buyer then ends up paying you a multiple on a 50% EBITDA margin, that EBITDA margin is not going to get higher over time. At best case, it's going to stay the same, but most likely it's going to get lower. So again, if we take that EBITDA margin from 50% down to 25%, and if that buyer paid a 3x on 50% EBITDA margins, if it goes down to 25%, which is still very, very healthy margin, right? Very healthy. Now that buyer didn't pay three, they paid six again, right? So that's another way that the buyer realizes this compression, especially when we talk about platforms like Amazon. There's a decent amount of margin compression that all of us have realized on the Amazon platform. So being able to understand that, like, when a buyer is looking at your business and you have these great profit margins, they care less about what it did previously because that's on the seller's side of the ledger. They care more about what's the business going to perform at going forward. And if what they're underwriting is like, hey, this business is not going to perform at 50%, we're happy to give you a 25% EBITDA margin because that's what we feel like this thing will settle in at. The buyer is not doing that to be unfair. They're just trying to say, like, hey, we're trying to also understand that once we own this brand, how is it going to perform? And more times than not, 50% or 30 or 40% EBITDA margins aren't going to stand there. It's likely going to come down over time. So taking some sort of normalized EBITDA approach might be the scenario there in that case. Now, the disclaimer is I don't know many that have 50% EBITDA
Yeah,
margins now
that's pretty extreme. Yeah.
to prove a broader point.
Yeah, thank you for clarifying that. And I think, how can I put this? Everything's got to be done on some kind of basis. But the fact is that valuations of companies are extremely squashy compared to, say, real estate or, let alone, residential real estate, aka property in the UK. There are lots of comparisons with things. There's a lot of activity. It's a very relatively not liquid market exactly, but it's a very active market. It's easier to put a value on that, right? And so we need to make sure that whilst we have something and it's trailing 12 months EBITDA or preferably trailing 3 years EBITDA and averages in some cases, we've got to have a number to start with, but we've got to, as you said, see that as a guide to the future, and that is its only actual value, right? The past is only valuable insofar as it points to the future. So we have to use SDE trailing and then adjust for reality, I guess, right?
Yeah. Yeah, absolutely. And there's ways for buyers to basically say, like, look, we need to take a normalization on what your EBITDA is. But if we're wrong that there's not that margin compression, we could pay you an earnout, right? And therefore it aligns the seller with the buyer. And I think that that's kind of how most buyers look at things is like, let's create alignment together. So if we win, you win too.
Totally makes sense. And that's a very elegant structural solution, to make sure that you've set up a deal that allows for what you think is probable, but then allows for being wrong in a nice way. And then everyone benefits. Hey, folks, thank you so much for listening to another episode of the 10K Collective. This was with Michael Sirpilla of Society Brands, and we've been talking all about acquisition. Lots to absorb, and I know this has been a substantial episode, so I don't want to say too much, but a few reflections for me. First of all, so much has changed, and the last time I spoke to Michael was about 3 years ago. I guess that would have been in 2021. The landscape has changed. The good news is that if you have a business you want to sell, there are still people out there acquiring. The bad news, I guess, in some ways, is if you've got a small business, there's a less of a market to sell it to. So Michael and his company are perhaps more typical of the buyers out there that are looking for bigger brands. They're more realistic about how much they should pay for it, and the number that's based on the profit number, the normalized margins and or normalized earnings. And I would urge you, if you're a business operator that is beginning to think about building a brand to exit, that you go back and listen to that bit. I think that's so, so important to understand what it is you're selling and what that number is based on. So those are the things that really strike me the most. I mean, I think there is a more selective set of buyers out there, as indeed there were pre-aggregators, if you like. But if you're building a quality brand and you're heading towards the several $1 million in EBITDA, so earnings, profit, to put it simply, operating profit, then it might be worth you reaching out to Michael and his team. Or even if you think you're going to get there in a few years' time, you don't necessarily have to sell your brand to them now. They can help you to grow the brand as well. So if in doubt, reach out to them. leads@societybrands.com. That's LEADS at societybrands.com. You can obviously also check out the website. And Michael is, of course, on LinkedIn, who isn't. So I think there's a couple of reality checks to look at on your own business. And even if you're not planning to sell soon, I think it's good to be real about the value of your business to a potential acquirer. If you are, however, wanting to sell quicker and therefore you're in a much earlier stage of business growth, so you got valuation, your EBITDA, your profit is lower, then I might throw my hat in the ring as potential acquirer. I am looking to acquire businesses with between about $500,000 up to $5 million or pounds in revenue. And again, you still need to think about the earnings. STE is not real, but we can have a conversation about that. So just get in touch if you want to get in touch with me about that, michael@amazingfba.com, and we can have a conversation. Next episode is with Michael Sirpilla, and we are talking about what happens after the letter of intent, LOI, or heads of terms if you're in the UK, is sent. So you basically agreed a sale, but what about due diligence and what happens after the business is acquired? Let's talk about that in the next episode. Meanwhile, thank you so much for listening to the 10K Collective and the Amazing FBA podcast.